Let me start with something most people don't like hearing. The stock market doesn't reward confidence. It punishes it, especially when that confidence is built on stories instead of reality. And right now, there's a story a lot of investors are telling themselves. A very comfortable one. A very expensive one. This time is different. That line has probably destroyed more wealth than bad luck ever did. Not long ago, Sir John Templeton, one of the greatest investors to ever do it, called those four words the most dangerous words in investing. And he wasn't being dramatic. Because every time people say it, they stop asking questions. They stop checking risk. They stop seeing what's right in front of them. And that's exactly when things go wrong. Now let me introduce you to someone who understood this better than most people alive today. It's Jesse Livermore, a trader who made and lost fortunes in the market multiple times, a man who lived through booms, crashes, manias, collapses, and the full spectrum of human financial behavior. And after all of it, after everything he'd seen and lost and rebuilt, he said something remarkably simple. There is nothing new on Wall Street. What happens today has already happened before. Different companies, different headlines, same behavior. That's the part most people miss. Because right now, if you look at the market, it feels modern. AI stocks, tech dominance, big names leading everything. It all feels like something we've never seen before. But we have. And not in 2008. Not in the dot-com crash. I'm talking about something older than that. Something most investors never study, never hear about, and never see coming when it repeats. The Nifty 50 bubble of the early 1970s. And if you pay close attention to what happened then, and what's happening now, you'll start to see something that should stop you cold. So let's go back. Late 1960s. America was flying. The economy had been growing for decades straight. Jobs were steady, industries were booming, and the standard of living had climbed to heights previous generations couldn't have imagined. People felt safe. Not just safe, invincible. And when people feel invincible, something dangerous happens inside their minds. They start taking more risk, but they don't think of it as risk. They think of it as certainty. The stock market reflected that mood perfectly. From the end of World War II to around 1970, the US market had climbed more than 300%. 300%. And a run like that doesn't just grow your portfolio, it rewires how you think. It makes growth feel normal. It makes dips feel temporary. It makes winning feel like the natural state of things. And out of that mindset, that dangerous, seductive, completely understandable mindset, a strategy was born, simple, clean, deadly, buy the best companies in America and never sell. No timing the market, no watching valuations, no second guessing. Just find the greatest businesses in the country and hold them forever. These companies became known as the Nifty 50, and they weren't random picks or speculative bets. They were the most trusted names in American business. Household names that had been around for decades. Companies like Coca-Cola, McDonald's, Xerox, Polaroid, American Express, IBM, Johnson & Johnson. Strong brands. Real profits. Dominant market positions. The kind of businesses that made you feel foolish for even questioning them. And that feeling, that sense of absolute safety, is exactly where the problem started. Because once people believe something can't go wrong, they stop caring about the price they're paying to own it. And price is everything. Here's something that sounds simple but that most investors still get wrong today. A great company is not always a great investment. The price you pay matters. It always matters. It never stops mattering. Back then, the average stock in the broader market traded at roughly 15 times earnings. 15 times. That's normal. That's healthy. That's a reasonable price to pay for a share of a company's future profits. But the Nifty 50 were in a completely different world. Coca-Cola was trading above 40 times earnings. McDonald's climbed higher. Some of the most popular names were being bought at 60, 70, close to 90 times earnings. Think about what that means. Investors were paying 2, 3, even 5 times what the rest of the market was worth for companies they believed would grow forever. And here's the part that should chill you. They didn't care. They genuinely did not care about the price because they believed these stocks were permanent, untouchable. The phrase going around Wall Street at the time was this: these are one-decision stocks, meaning there was only ever one decision to make. Buy. That's it. No exit strategy, no risk management, no asking whether 90 times earnings was too much to pay. Just belief. Pure, unquestioned, expensive belief. And it didn't stop there. These stocks became so popular, so universally owned, so deeply embedded in every major portfolio that they started to dominate the entire market. At their peak, the Nifty 50 represented nearly half of the total US stock market by value. Half. That's not a portfolio. That's a single bet. And when too much weight sits on too few names, the entire system becomes fragile in a way most people don't recognize until it's too late. Then, 1973 arrived. And reality doesn't announce itself. It doesn't send a warning. It doesn't give you time to adjust. It just shows up. Oil prices surged as OPEC cut supply. And America, which had built its entire economy on cheap energy, suddenly had no answer for it. Inflation didn't tick up. It exploded. Double digits. The kind of inflation that doesn't just raise prices. It destroys the math that justified every premium valuation in the market. Unemployment rose sharply. Consumer confidence collapsed. And the economic structure that had supported 30 years of growth began to crack from multiple directions at the same time. That's how markets actually break. Not from one clean problem you can identify and solve. From pressure building in multiple places simultaneously until something gives. And when it gave hard. The broader stock market dropped around 50% between 1973 and 1974. But the Nifty 50, the untouchable ones, the one-decision stocks, the names people had bet their retirements on, they got hit harder. Much harder. Coca-Cola fell more than 60%. McDonald's dropped over 70%. Some of the most beloved names in American investing lost 80%, even 90% of their value. And here's the thing that matters most about what happened. These weren't bad businesses. The companies didn't fail, they didn't collapse, they didn't disappear. They kept selling burgers and soda and office equipment. The hype collapsed, the premium collapsed. The belief that price didn't matter, that collapsed. And when you've paid 90 times earnings for a company that the market decides is only worth 15 times earnings, the math is brutal regardless of how good the business is. That's what overpaying costs you. And then, as if the losses weren't enough, recovery wasn't quick. There was no sharp bounce, no V-shaped return to glory. No, just hold on. It'll come back next year. It took nearly a decade for the market to return to its previous highs. 8 years. Think about that. You believed in the greatest companies in America. You paid a premium because you were certain they were worth it. You watched them fall 60, 70, 80%, and then you waited, and waited, and waited. 8 years just to break even. That is what blind optimism actually costs when the math finally catches up. Not just money, not just losses on a screen. Years of your life, years of your retirement timeline, years you cannot get back. Now stop. And look at today. Look at today's market carefully. Because something familiar is happening. A small group of companies is dominating everything, driving the majority of the gains, carrying the entire index. Today, they're called the Magnificent Seven. So Microsoft, Apple, Google, Amazon, Meta, Tesla, Nvidia. And listen, these are powerful companies. That is not in question. They lead their industries. They generate revenue on a scale most countries can't match. They are genuinely shaping how the world works. But that's not the point. The Nifty 50 were also powerful. They also dominated their industries. They also generated real revenue and real profits. They also looked to every serious investor at the time, completely unstoppable. So the question is not whether these companies are good. The question, the only question that actually matters, is how much people are willing to pay for them. Because once again, valuations are climbing to territory that history says should make you uncomfortable. Some of the Magnificent Seven are trading at 30, 40 times earnings. One is sitting above 200 times earnings. 200. And once again, a handful of companies now represent a concentration of the US market that we haven't seen in decades. which means exactly what it meant in 1973. If they stumble, if any meaningful number of them disappoint, the whole market feels it. Not some of the market, all of it. And right now, most investors aren't asking whether the price makes sense. They're asking a completely different question. Can it go higher? That shift from "is this price rational" to "can it go higher" is not a subtle thing. It is the single clearest signal that a market has moved from investing into something else entirely. And this is how every bubble forms. Not from bad companies being overvalued, from good companies being priced as though perfection is guaranteed. It starts with strong performance, which is real, which is earned, which is legitimate. Then attention follows performance. Then belief follows attention. Then overconfidence follows belief. And then, quietly, without most people noticing, the last step happens. People stop asking whether the price makes sense. They stop running the numbers. They stop stress testing their assumptions. And they start doing exactly what the investors of the late 1960s did. They start treating great companies as permanent certainties. One-decision stocks, buy and hold forever. No exit plan. No valuation limit. No price too high. That is when risk is highest. Not when things look bad. Not when headlines are scary. Not when the market is falling and everyone is nervous. When everything looks perfect, that is when the trap is set. Because perfection is the most expensive thing you can buy in any market. And it has never, not once in the history of financial markets, delivered what it promised at the price it demanded. The investors who survive long enough to get wealthy understand something that most people learn only after they've been badly hurt. Markets move in cycles. Always have. Always will. Not because of conspiracy, not because of manipulation, not because the system is rigged. Because human beings are in it. And human beings follow the same emotional sequence every single time. Excitement first, when things start working and returns feel easy. Then confidence, when the wins pile up and doubt starts to feel foolish. Then greed, when caution starts to feel like a liability and everyone around you is making money. Then denial, when the first cracks appear and people find reasons to dismiss them. And then reality. And reality doesn't negotiate. It doesn't care how long you've held. It doesn't care how strong the brand is. It doesn't care what the headlines say or how many analysts have a buy rating. It responds to one thing only: whether the price you paid matches the value you actually got. When those two things are aligned, markets are stable. When they diverge, when price runs far ahead of value, something always, eventually, pulls them back together. Sometimes slowly, sometimes violently, but always. Smart investors don't chase the story. They watch the numbers. They watch valuations, not just whether a stock is going up, but whether the price being paid can be justified by any realistic projection of future earnings. They watch market concentration, because a market where 5 or 7 companies account for a third of total value is a market where a very small number of things going wrong can cause a very large amount of damage. They watch investor behavior, because the way people are talking about stocks tells you more about where you are in the cycle than any earnings report ever could. And they watch macro conditions, because inflation, interest rates, employment, and energy prices don't just affect the economy in isolation. They affect the math. And when the math changes, the premiums people were willing to pay have a way of disappearing very quickly. Here's the truth most people avoid because it's uncomfortable. The market doesn't care what you believe. It doesn't protect your confidence. It doesn't reward your conviction. It responds to numbers, to earnings, to the cold, unforgiving relationship between price and value. And when those things don't match, something adjusts. Maybe not today. Maybe not this quarter. But the gap between price and reality has never stayed open forever. Not once. Warren Buffett said it plainly. What we learn from history is that people don't learn from history. And right now, there's real evidence he's being proven right again. Because right now, the market is top-heavy in a way we've seen before. Right now, a handful of names are carrying the entire index in a way we've seen before. Right now, valuations are being rationalized instead of questioned in a way we've seen before. And right now, In conversations on financial forums and brokerage platforms and dinner tables across the country, people are quietly saying the same four words that Sir John Templeton warned us about half a century ago. This time is different. The companies are better, they say. The AI revolution is real, they say. These aren't just stocks, they're infrastructure, they say. And maybe some of that is true. The companies in the Nifty 50 were also better than what came before them. The growth was also real. The dominance was also genuine. None of that saved the investors who paid 90 times earnings and waited 8 years to break even. Because the market has heard, this time is different before, many times, in many different forms, with many different justifications that all sounded completely reasonable at the time. And it has never, not once, ended well for the people who believed it without checking the price. The question isn't whether the Magnificent Seven are great companies. They are. The question is the same one it's always been. What are you paying? And what happens to your portfolio if the market decides that 200 times earnings was too much to pay? The same way it decided 90 times earnings was too much in 1974? That's not a prediction. That's a question. And the investors who are asking it right now are the ones who won't be waiting 8 years just to break even.